Welcome to Better System Trader Live. Glad you could join us today. You can't actually see, but our guest was dancing like a crazy man off camera. Can't wait to get to it. Today we're going to be talking about superior returns from superior risk management. So let's get to it. Well, hello and welcome. It's good to be back. This is actually my first one of the year. That's right. I took a little break from podcasting because I had some other projects I just needed to finish up, but it's really good to be back, and I hope everyone has been doing well so far this year. Hey, baby. Good to see you. Baby Panda's here. Jabberjaw. G'day from Boston. Horo from Canada. G'day. Horo. Well, today, as I mentioned, we're going to be talking about superior returns from superior risk management. That feels like a bit of a tongue twister today. A little bit rusty, but we'll get there. So our guest for today is a short selling specialist. I'm still struggling. Should have had some more coffee this morning. He worked for Fidelity many years ago. He's got and a number of other hedge funds over the years. He was the founder of Alpha Secure Capital and also Trader Logics, which I think we'll probably talk a little bit about later on. He has been a past guest of the BST podcast. He's always fun. He's always a fan favorite. Welcome, Laurent Bernut. Come on down.
Thank you very much, Andrew. Thank you very much for having me on this podcast. I'm honored. It's always a pleasure. It's always a pleasure. I always look forward to a conversation.
I wish actually that I was able to share some of your dance moves with the audience today. Do you want to pull out some? There we go. Good stuff. That's awesome. All right. Well, I've lost my train of thought already, but so you're in Japan at the moment, right? How's things in Japan?
Yeah. I'm in Tokyo. I'm overlooking Kyushu Q and Hamari Q in my home office. There's the Tokyo Bay over there. So how's Japan? Japan is sunny, a bit cloudy. In terms of confinement, we're actually doing fine. I mean, Japan is the only country in the world you throw pandemic at it and the death rate goes down. I can manage that.
I don't know if we can joke about that. I feel a bit awkward.
Exactly. Like there were 2 people who died out of the flu this year. Like only 2 people. Normally there's a few hundred and so forth. I mean, Japan. You tell Japanese people to be hygienic, like they're going to be surgical about it. So Japan is a very safe country to be in many respects.
Yeah. Well, that's good to hear that you're safe and you're doing well. So let's talk about trading stuff now. But perhaps first, a little bit of background on yourself for anyone who maybe isn't familiar with your work. So do you want to give us a bit of background on your trading style, markets, things like that?
Right. So trading style. I joined the markets in 2001. Before that, prior to that, I was a CPA, so Koninkai Keishi in Japanese. I was compiling financial statements in Japanese. Doing all this for a listed company. I was preparing the Yuka Shoken Rokusho, which is like the financial statements. And then when there was Enron Welcome and all this, I was contacted to, hey, you want to join into the market? You want to come into the financial market? Like, okay, why not? And then I developed more of a quantitative bent. It's easier to cover a lot of ground.
Yeah.
And then in 2000, I joined several hedge funds, 2 hedge funds in a row. And then in 2007, I thought, this is way too easy. I mean, the game was way too easy. So I thought, okay, I'm going to leave the hedge fund, and I joined Fidelity. And also, it was a love at first sight with my boss. Fantastic guy. And been there for 8 years, somewhere like this. And in 2015, I set sail. And then I'm still going on. So it's still very much a quantitative approach to short selling. I do long short. I mean, to me, long short tastes like chicken, you know? They all taste like chicken.
It's all the same.
It's all the same. You do Forex, you do equities. Like, dude, it tastes like chicken. So what I do trade actively are Forex pairs. And we can talk about it with something that I developed for TradeView. Then I also trade actively ETFs. So there's a bit of there's a truncated equity curve in the end, so we can see. What else? I help couple of shops with their shorts, primarily on the Japanese equities.
Hmm.
That's pretty much it, really. So in
Okay.
terms of style, I developed something called the floor and ceiling, which is like, when market makes a peak and then it makes subsequent swing highs that are materially lower, then it tells you that, okay, that thing is about to go either sideways or down, and vice versa. Market prints a bottom, prints a higher swing low, materially higher. Cumulative probability tells you that maybe it's going to go up, and do this in relative, absolute, and so on and so forth. So that's
Okay. Well, I think we're going to get into some of that a little bit later. I kind of want to start off with a question that's a little bit tongue-in-cheek, but also has a serious professional nature to it, I guess. And that is, it's kind of a question that a lot of beginners and newbies in trading ask, and is, how can I turn a small amount of money into a larger amount of money? For example, how can I turn 10K into 100K into $1 million I want to do it in 1 year, 2 years. Now, it's a bit of a crazy question, and there is obviously some danger to that, but there is also some underlying, I know that it's a bit of a leading question because I know you've got some cool stuff you're going to share. But first of all, what's the danger in thinking like that?
First, let me answer the question straight. Very simple answer. How can you turn your miserable 10,000 into $1 million into 2 years? Very simple answer. Send me the check. Next question. First, what's the danger in thinking like that? All right. The danger in thinking like that, and actually the mental process, the mind process that people go through is, all right, we all come like this. Okay, I just inherited, or I just landed this amount of money. How can I turn it into an unreasonable? So first thing you need to understand is that professionals who've done it, who spend an inordinate amount of time perfecting the craft, they clock 10, 15% per annum. 15%, like, whoa, in a rarefied atmosphere where, like it's like the layer cake. You're in the rarefied atmosphere where shit doesn't smell anymore. So I think unrealistic expectations is setting you up for failure. So that's the first thing. So, and if you take, like, for instance, Larry Williams had a great quote about it. When he turned 10,000 into $1 million, he realized afterwards, like, well, maybe we took a little bit too much risk. Like, the drawdown at 95% halfway through was not the best idea we had. And I have immense respect for the gentleman. Don't get me wrong. I mean, he's a pioneer. The second thing also is like, then the mindset is, okay, we're gonna focus on the signal. I can find a better mousetrap. I can have my 100% win rate. I mean, you can't. You can. It's like love. You can be loved or you can be right, but these are two different doors. So I think focusing on the entry, and it keeps people addicted to failure. Would you like me to elaborate on that one?
Yeah, well, I was going to say, if that's the result, then what should they be focusing on instead?
So if you focus on entry without thinking about the exit, basically, what it boils down to is people want to hand medal before the horse race. They want to shuffle medals. They want to give the medals before the horse race. The only time when you know how much money you make is after you close the trade. So it's the exit. That's number one. So that's for the signal module only. Anything before that is called paper money. And if I know one thing in the finance industry, is that the only thing that is cheaper than toilet paper is backtest print and paper money. So now that we've cleared the deck, let's move on to another thing. So what really makes a difference is how much you bet, is the position sizing. Oh, hold on, I'm going to pull the curtain. Sorry about this.
Yeah, something's happened to your camera there. I thought maybe it's getting a bit steamy. There you go. Can see you again. Beautiful.
So, thank you. Okay. I'll bang that one.
Okay. First one's for free.
So, if you think about trading strategy, I mean, if you think about a trading edge is not a store in China. Trading edge is a mathematical formula. It's called gain expectancy.
Mm.
So, wow, man, the flower, the pollen of the flower. And so the idea there is how much money you make on average times how often you win minus how often you lose times how much you lose on average. Now, the signal module is what it is. Life is what happens to us when we had other plans. But on the other hand, it's how much you bet that really makes the difference. It's not how often you win. If you look at the people who made billions of dollars, like all the trend followers, the CTOs back in the days, these people had win rates of 33, like Bison and Mason, Richard Dennis and William Eckert. They said that that long-term average win rate was 35%, which means that they expected every single trade that they took to be a loser. So they walk into a trade thinking that this one is going to be a loser. Ooh, it actually worked. Awesome. And now we can talk about this in a different context in terms of scaling out. It's a different thing that we have at the end of the slides. But
yeah.
So on the other hand, what really makes a difference is how much you're going to bet. Whether you bet $1 million, whether you're going to bet $1,000, you're going to have different outcome. And unfortunately, the win rate is not something that is fixed and continuous. Life is what happens to you when you're at other plan. There's a sort of seasonality. Every system, every strategy ever built works until it doesn't. And then it starts working again.
Yeah.
So for a rookie, they keep on tweaking their system. Being addicted to failure is basically going through all the newsletter, trying to do all the research, and then abandoning it, tweaking it, and moving on to the next one, and the next one, and the next one, and the next one. If you look at people who've been on the business for a long period of time, they really keep it simple. They really boil it down. They don't need to do all those wushu kung fu moves 25 times and all the kata before taking on a trade.
Yeah. Yeah.
Like the great Chinese philosopher Bruce Lee used to say, I do not fear a man who throws 10,000 kicks one time. I fear the man who's thrown one kick 10,000 times.
Yeah. Yep. So before, I know you've got some examples to explain a bunch of the comments that you just made. But first of all, I want to define part of the question or part of the topic for today, and that's superior risk management. So how do you, what's the definition of superior? I mean, it's a pretty loose kind of terminology. How do you define superior risk management? What are you trying to do?
Oh, that's actually a fascinating question. I've never actually thought about this. I can give you a mathematical answer for that, but I actually never thought about it in terms of epistemology. I think we're going to go way beyond 45 minutes. Superior is, let's start with the outcome. It's something that will give you superior results. Not only superior results, because investors think in returns like, investors are like teenage girls.
Uh-oh.
They say, teenage girls always say, I want to meet a good guy. And then they react to the same bad boy with a different name every time. Investors will always tell you, I want to have good returns. And then they react to drawdowns. They react to drawdowns in 3 predictable ways. I mean, again, investors are like teenage girls because they're very predictable. So they react to drawdowns in terms of magnitude, never test the stomach of the investors in terms of frequency, never test the stomach again, or the nerves of your investors, and duration of drawdown. Never test the patience of your investors. So when I'm talking about superior returns, it's actually controlling drawdown. And this is really the essence of what we're going to be talking about today.
Yeah.
If you can weather drawdowns, then you're going to be fine. If you build a boat, like you don't build a boat for fair weather days. If you're gonna circumnavigate, you don't build a boat for fair weather days.
Yep.
You build a boat. It might not be the fastest boat, but you want to be have a boat that will survive the storm. And that's really what it means to build something for superior return. Not the best, not the fastest, but the steadiest. Something that, like my wife says, or like No, actually, when we went to the lawyer, like, oh, but your husband, when he goes to jail, like, wait, it's not because I work in the financial services I'm going to land in jail for in the first place. But when you land in jail, or when the bus drives back and forth over you, you still want that thing to keep going. For it's transgenerational, and this is really what we're talking about, the essence of what we're doing today.
Yeah. Okay. So I like that analogy of building a boat for the the worst environments or worst conditions. How do we then translate that into trading?
Let's go through the slides.
Let's go to the slides. Yeah. All right. Let's see.
And the pool. These things, they smell good, but you know.
I appreciate you got a beautiful orchid there for this chat today. It's great. So here we go.
Right, here we go.
Is this what we're looking at first?
Okay, so this is not my equity curve. So I simulated an equity curve, and then we're going to run through the simulation. Everything is written in Python, and so here I simulated an equity curve. I think it's the Nikkei. Yeah, it's the Nikkei. First things first. If you have an equity curve like this, stick to barbecues. Send your computer back and stick to barbecues. The financial services are not for you, love.
Which one's the equity curve? Is that the black line? What are we looking at here?
The black line is the equity curve. Then the green line is called the watermark. The watermark is the peak equity curve. And then underneath the dotted red line is the tolerance for drawdown.
Right.
So what is tolerance for drawdown? If you look at shops like Millennium Partners, for instance, at 5% drawdown, they withdraw 50%. They will withdraw 50% of your assets under management. So literally, it's how much you can stomach. This is really important. Like, life is what happens to us when we have other plans. Like the Geneva Convention War Crime Bingo world record winner Donald Rumsfeld used to say, there are known unknowns and there are unknown unknowns. So you can't really foresee what happens. Your strategy at some point will not work. And at some point it will work. And you need to define how much. The tolerance for drawdown is how much you're willing to tolerate until you trade minimum risk. And when the strategy works, you should load up the risk. You should load up the boat. And don't do it the other way. Like, oh, I'm going to double the Martingale. Like, oh, I'm going to double down. I'm going to double my bet every time I lose. This is called Martingale. Now, Martingale has a very interesting statistical property called certainty of ruin, which means that the idea is if you double down until you win, the idea is that except for the one time where you win, the final time when you win, every single outcome before that means that you will go broke. That's number one. Number two, you need infinite amount of money. So some people in the hedge fund world these days, like after shorting GME, they've clearly understood that they do not have an infinite amount of money. Neither do the investors. So the whole idea there is when the strategy doesn't work, you're going to withdraw some risk. When the strategy works, you're going to be aggressive. And that's it. You're going to need to weather the storm. So this is what the red dot is about. Now, the thing in light coral is the upper part of the chart. One note, never trust a Frenchman with the color scheme. You're going to have a whole bunch of pastels. So the light coral is the drawdown. It's basically the percentage drawdown from the watermark. All right. That's so we've set the stage here. We've seen that, okay, we have a strategy. It works. It doesn't work. We have a drawdown. Slide 2.
Bing. There we go.
Okay. So this is the standard modus operandi of a lot of hedge funds. Also, in this case, okay, the formula here is I'm going to risk my equity. I'm going to risk a percentage of my capital. It's called equity at risk. So in this case, I'm going to risk 50 basis points no matter what. So as you can see, the risk is negative. So it's inverse. It's the inverse scale. So when the strategy works, which means when the drawdown is close to zero, when the drawdown is close to zero, when we're making new highs, I'm going to risk more. So that means the gray line is going to go down. On the other hand, when the strategy doesn't work, so it's equity times fixed risk, like 50 basis points of risk or whatever that is, or 25 basis points, whatever that is. When it doesn't work, I'm going to take less risk and so on and so forth. So it's very much responding to the equity that we have now. Okay, So slide 3. So this is the standard modus operandi. It's always the same speed. Before we go to slide 3, I'd like to give an analogy.
Sure.
So, this is basically like the transmission. Position sizing, there are 3 things in a strategy. Number 1 is the engine. So that's the signal engine. If we think about the gain expectancy. Number 1 is the signal. Number 2 is the transmission. How much risk you're gonna pull in. So this is what it is. And in this case, it's fixed gear. Now imagine you take somebody on a date and you drive across the countryside and you're going to be on fixed risk all the time. So basically, you're going to show up with your Lamborghini or your Ferrari and you're going to be driving in first gear or in fifth gear all the time. And when you, so that's not, what happens is, when it starts working and after a couple of miles on the road in first gear, when you're going to be plowing and the engine's going to be screaming, you're going to jump to fifth gear. Well, that's not exact. If you want to pass down your genes to the future generations, you might want to have a smoother sort of ride, which leads us to slide 3.
Boom, slide 3. There we go.
Here we go. So now the idea, the gray line is still the same gray line that we saw before. So before it looked like, wow, it moved a lot. But now we're going to use a different line. So the formula here is we're going to use the watermark, which is the peak equity. Always use the peak equity. So that's the maximum that you always have. And then you're going to basically have it oscillate between the maximum risk, which is the cyan line that we see at the bottom, and the minimum risk that we see at the top. And somewhere in between, when the strategy works, you're going to re-accelerate. And when the strategy doesn't work, this is where we have the tolerance for drawdown. We're going to rebase it to 100%. So let's say, for instance, okay, I'm going to tolerate 5%, which is what we saw before. But if it goes to 10% drawdown and so on and so forth, you're still going to trade minimum risk. And then when it moves beyond the 5% drawdown, like -3, -4, then you're going to re-accelerate. So as you can see, it's much more dynamic. So the times when the strategy doesn't work, you're actually going to pull back risk. Really, really trade small. Basically, you cannot win the lottery if you don't buy a ticket. It's going to be a lot harder, trust me.
Yeah. So before sorry, go
please.
on. I don't mean to cut you off.
No, please.
I was just going to say before we look at the results of that kind of thing, the example you were using there, how do you determine the increments of the drawdown levels to adjust and also the amount of risk for each level? Like, what's the process to determining that?
Okay, that's an excellent question. All right, so there are things like Kelly criterion for position sizing and so on and so forth. Now, Kelly criterion is great until you have to manage people's money for real. Again, it goes back to the same idea of drawdowns. So, and it also depends on the number of issues of stocks that you have within your portfolio. It also depends on where the stop loss is. So we're basically talking about a 3-dimensional array here. It's a little bit more complicated. But in terms of risk per trade, for instance, in the example here, it's 33 basis points on the minimum and 1% on the maximum. 1%, I would never trade that as a professional for anybody's money. Even though the system can stomach it, investors will not. Because I didn't mention the third part. The first part is the signal. The second part is the transmission, like the position sizing. And the third part is the eco-unfriendly driver who goes and wraps 2 tons of metal around a tree. Right? So the idea there, when we have the oscillator that we see here, what is interesting is, you see, for instance, for 33 basis points to 1%, it's like 3 times more. And so there's a built-in lag in here. How do we manage to either re-accelerate? Because what you definitely do not want is like, okay, let's say you have a choppy strategy, or it's a choppy market, or it looks like it's working. You re-accelerate, and right around that time, as we all know, once you have a peak equity, all right, I'm going to get hosed around the corner. I'll have too many good returns in a row. This is not going to be pleasant. And vice versa. At the bottom of a losing streak, you feel like, all right. I mean, McDonald's, are they still hiring? Tully? Starbucks. I saw a flyer last week. So we are very
Yeah.
depressed. And this is why actually giving it to an oscillator like this, when you sandwich the risk between what you can stomach, the most important thing about this is something you must be able to trade. This is why for me, for instance, the bottom part is 25 basis points. And the upper part, it could very well be, because of the win rate that I have on the long side at the moment, they're like 88%. It's unreal. It's surreal. But I would never trade 20% risk. I just couldn't do it. I wouldn't be able. I mean, tourists, they bet the farm, and pros, they milk the cows. So I want to be able to show up tomorrow and trade another one.
Yeah.
I don't want my emotions to step into the high roller table. I'd much rather be very surgical about it. I have a great story about this, but this is probably what we're going to see at the very last slide if we ever come to it. So let's move on to great story.
That was a nice hint. I get the hint. All right, let's move on.
But so the idea now that we're here, we have basically an oscillator. And now what we're going to do, we're going to look at the acceleration. Option traders who look at the strategy here, they're like, oh yeah, dude, I see you coming from a mile away. Convexity. Tell me something. Guys, stop rolling your eyes. My wife does a better job than you. First. So we'll go to the next slide. So we're going to talk about concavity and convexity. So concavity is basically the 45 degrees line that we see here is the oscillator that we saw before. So it just moves like, okay, for 1 unit of drawdown or for 1 unit of recovery, it moves in a very linear way.
Yeah.
Now the concavity is basically sub-zero, sub 1. So when there's an acceleration to it, and this is really what we want. What we want is a system that actually, when you get hit, it wants to stomach volatility, small bouts of volatility. That doesn't really matter. You still want to keep risking as much as you can. Yeah. And when you have a drawdown, it slams the brake, and then it reaccelerates. This is really what you want. So this is very much a front foot kind of thing. This works particularly well when you have a concentrated form of portfolio. When you have hundreds of names, it's a different one. The next one is the convex. So convex is basically, this one is as much sharper. So this is very much for diluted portfolios. When you have like 60 to 100 names on one side, you can afford that kind of thing because they both more or less balance one another. So these are basically on one side and on one end and the other side of the midline, which is like, so this is next slide, this is what we're going to look at.
Okay, so the next one now. So just before we move on, actually...
Do I make sense? Do I make sense so far? You have questions, or please interrupt me at any time, otherwise...
Oh, don't worry, I will. I just want to make sure I got the point there. You just said about selecting between convex and what was the first one? Concave is basically the number of strategies or positions you have. So is that the implication that the diversification kind of reduces the risk, so you don't need to, you can adjust this based on that? Is that what you're saying, or did I miss the point there?
Exactly. That's exactly the point. When you have concentrated strategies and with big weights, you want to have a concave, so you really want to slam the brakes very early on.
Yeah.
But when you want to, I mean, not early on, but as much as possible with a lot of reacceleration, because concentration is the first, the primary determinant of volatility of the portfolio. Makes sense, right?
Yeah.
And on the other hand, when you have a very diverse portfolio with lots of small names and small positions, in this case, you don't have those spikes. So it's much more dilute. And it's also, for instance, it also depends on the type of strategy that you're doing. If you're doing mean reversion, you're going to be right more often than not, in which case convexity more or less applies. But again, this is empirical. So this is what I mean. When you do the backtest, this is what it sort of shows up. But personally, I like concavity because I like one of my heroes. I tell my children, like, Muhammad Ali, that all you got, George. Now my 5-year-old runs around like, that all you got, George. Like, whoa, slow down, boy. Our kids are the same age, right?
Yeah, they are. Yeah. Just a question, another question before we move on to the next slide. Have you ever tried this? So we're talking here about basing the this concavity or convexity on the drawdown. But what about, have you looked at applying it to market conditions, perhaps, or something external to the strategy?
All right. So, okay. In French, we have something called a serpent de mer, which is a sea snake, which is, in my case, like the thing that you always, procrastination is a form perfectionism is a form of procrastination. And in my book, I talk about the same formula applies to the entry, which is the risk that for the incoming positions. And it applies also for the open position, for the open risk, for what is happening in the portfolio. Because let's say, for instance, at the moment, like, okay, your strategy works and you can afford to take more risk and so on and so forth. But when the positions are in, they're in. And then you have open risk. And for all the, okay, cool, you're going to reduce risk for all the open for the new entries, but you also need to reduce risk across the portfolio.
Right.
So how do you do that? And basically, it's the same oscillator. It applies at the entry stage and it applies for the portfolio stage. And it's the exact same thing. The input is different. I mean, the input is still the equity curve, of course, but then the input in this case is the open risk position by position within the portfolio. Make sense?
Right. Yeah, absolutely. There's a question here that's popped up. Kind of just links into what you were saying by Jabberjaw. Let me see if I can put this on the screen.
Oh, I like the name.
Let's see. Is it going to pop up? Here we go. Jabberjaw. Thanks for the question, Jabber. Small accounts prohibit position sizing or maybe limit position sizing. So what would you do in this case? Because you've been talking about reducing positions by a percent or 0.5% and up and down, which implies you've got a large account. What do you do if you've got a smaller account?
Well, first of all, I mean, if you're trading on margin, this is precisely the kind of thing that works very well with margin. This is the kind of thing you should be working on margin. So in this case, I disagree with you. I mean, I understand the idea. Don't get me wrong. I understand where you're coming from. Small accounts, you can't exactly size. It's one lot or not, especially trading futures. But for instance, if you trade futures, you're probably going to go through 6 ratio position sizing. I think it's Ralph Vince, great gentleman, and this would be with the optimal F. I mean, this would be very much the kind of thing where you would be using this. So this oscillator, the problem when you have a small account is you're going to take a much bigger fraction of risk. I was having this conversation with Laurent Bernut, like the founder of TraderLogix. I said, you know what? The day when I have $1 billion, all I want as returns is inflation plus 10 basis points. That's exactly what he was saying, because he was telling me about his PAs. He was telling me his returns for the year. Like, oh man, I clocked 300%. Like, and I told him, yeah, small account. Yeah, small account. But the day I'm at $1 billion, I just want a little bit. So when you have a small account, you don't have a choice. You don't have a choice. You have to take more risk. And as the account grows, you can either stay with high risk, or you naturally tend to reduce the risk, and this ties in against with the study that I wanted to show, and that I will demonstrate it if we have to. But that's for a later slide. I like the cliffhanger, right?
Okay, let's move on. I just want to share a comment from Baby Panda, another cool name. G'day, baby. I get this 100 times more clearly now. Lauren has tried to explain it before, but now you did a good job today, Lauren. So pat on the back for that one. Now, thanks, baby. All right, let's let's keep moving, because I know you've got some more slides to share. I don't want people to miss out. So I've kind of forgotten where we're at. So let's have a look at the slides. Okay, so we were looking at. Were you going to say something?
This is the convex. No, I was just looking.
Yep. Okay, what do we got here?
So now this shit's getting real. This shit's getting real. So we still have the gray line. I mean, I took out the light coral, drawdown.
Not the light coral. Yeah. Oh no.
Yeah, I know, right? But then if you look at the medium orchid.
What's that? Is that purple or blue or What's a medium
All right,
orchid?
purple, right? Purple is the
Yeah.
concave. Purple is the concave stuff. And then if you look at the what's that? Light blue sky, which is like the light blue kind of stuff, right?
Yeah.
You look at that one. This is the convex, and then the standard blue, like plain vanilla blue, that's the regular oscillator. So what you can see with the medium orchid is that it's much more responsive.
Mm.
So it's really like tit for tat kind of thing. It's tit for tat for acceleration. Because one thing that I realized, originally I just had the simple oscillator, and I thought, man, that thing is plowing like a tractor. I thought, how can I turn a tractor into a Lamborghini? Because it's the same engine. I realized that basically what I had originally is like 25 basis points to 1%. It's plowing. So I thought, okay, convexity. Yeah, I know the option guys. Like, stop rolling your eyes. My wife does a better job than you. And and the idea there is if we use concavity, what happens is as soon as, as you can see, like in the beginning of the 2019 or something like this, as you can see, it does when the light blue is very choppy, this one is fairly stable. Even when the oscillator is very choppy, this one is stable. But on the other hand, it's really reacting well when the market tanks. And again, there's a lot of reacceleration thereafter when you see that actually we're not making as many drawdowns as before. I mean, when we're moving into new highs, it's really reaccelerating. So this is why personally I side with the concavity. So it's very, very responsive. It slams the brakes, it reaccelerates. And this is basically the ratio of if you use concavity, is the ratio of your minimum risk, let's say 25 basis points. It's 1 over 25 basis points, basically. It's 25 basis points. When you use convexity, it's 1 over 25 basis points in this case. So it's the minimum risk divided by the maximum risk. Let's say it's 25 basis points to 2%, it would be 0.25. 25 basis points divided by 2. If it's the concavity, the convexity would be 2 divided by 25 basis points, which would be 4, something like that, or 8. Something like that, right? So you guys are good at math, right? You figure it out.
Might have to go back and watch the replay to catch that.
That's right.
Yeah.
And so that's it. Very much that's it. Now, how do we see this in practice is what we're going to see next. So that's it. So now that we've done it, in this case, I just focus on the concave because that really is really striking. We could use the convex as well. But what you can see here is the same equity curve that we saw before with the same watermark and then the same tolerance for drawdown, which is the dotted red line. And then on top of that, on the above chart, we have the concave, which is the medium orchid. And then
purple.
We have the purple, and then the light slate gray. Never trust it. Light slate gray for the fixed risk. And then you can see really that actually when the strategy is making more, when the strategy is working, you're really plowing like, come on, get all you got, George. But on the other hand, when it's not working, it's just a bit of rope-a-dope. And it's really working. So as you can see that actually when we tank below the tolerance for drawdown, we keep taking minimum risk. So instead of risking the same like 50 basis points, and taking it on the chin, risk 25 basis points or 30 basis points, 30 basis points. Small. But when it works, really reaccelerate. And why is it important? Because if you want to turn $10,000 into $1 million, the transmission is how you're going to plow the risk. So to go back to Jabba Joe's question is really when you should be betting the big bucks. If you bet the big bucks all the time, there's a very strong chance that either you'll give up, that's the most likely scenario, or you'll go bust. As Van Tapp always says, undercapitalization is the number one reason for why people go bust. But the second thing is people give up before that.
Yeah.
So this is why the transmission like this really helps you navigate. When it works, just plow.
Yeah.
After GME, go buy BlackBerry. I forgot what the third one was.
I think they're working on silver now, aren't they? They're trying to crush the silver shorts. But,
Man, I was wondering because you know what? I got into silver. I forgot. I got into silver. I got closed out because I have a scale out system, and then I got back into silver. And that thing, like, whoa, out of nowhere.
yeah,
And
had some good
you know,
moves.
like one of the fund managers at Fidelity, I used to give him ideas, and then he's like, "But why?" Then I told him, I look at him like, "Ron, do I really look like I know why?"
Does it matter?
Tastes like chicken.
All right, so let's get back into the examples. I think you've got some other slides, but what I really like about what you're sharing is that it's a bit more of an elegant solution to just a fixed risk. But we've been talking a little bit about the returns, enhancing the returns, but the other aspect of it is that you're really protecting yourself and you're managing the risk in a much more elegant way. And it's like you're putting it all on autopilot, right? You're letting the strategy do all the work for you.
Exactly. You let the market do the heavy lifting for you. Your job, as an unknown market wizard, your job is basically to place the orders. Yep. And the market dictates you, okay, this is how much risk I can stomach, this is how much risk you should be taking. And actually, it really, really simplifies the problem. It really simplifies it because one of the easiest things that people override all the time is the position sizing. Ooh, I'm taking on the chin, I should risk a little. And what happens is like people trade less and less and less and less and less, and they don't know when to reaccelerate. And vice versa. I mean, people like, I should say me, not people. Like, I'm not blaming anybody, but we've all been through that.
Yep.
Taking way too much risk at the top and way too little risk at the bottom. And then you delegate that to the market, it goes on autopilot. And you have your trading engine, you have your stats. Your stats give you, okay, how much you should be trading within that. That's it. Simplifies the problem.
Yep. Okay. Well, I think the next... sorry.
Or stuff like that. So go ahead.
How rude of me to cut you off like that. I want to get to the last couple of slides, which shows the before and the after effect of what you're talking about today. So is that where we're up to now? If I have a look at the slides.
Yes, sir.
Yes. All right.
So, no, we should do the one prior. Go down. There's one further.
Oh, no, did I just spoil the surprise?
Yeah, no money management. That one.
The order's wrong.
This one.
Go on.
Yeah, sorry about that.
Go on. That's okay.
I mean, this is something that I did. I had the privilege, the honor of being part of a conference done by TradeView, your fellow
Aussies,
your neighbors. Neighbors. You're just neighbors, right?
Yeah, I mean, we're neighbors.
It's in the best Greek food city in the world, i.e. Melbourne. Right?
Yeah. Well,
so this... Sorry.
No, I was agreeing with you. You can continue. Yep.
Oh, sorry. So this is what I did with a conference with TradeView, and I really, really like the guys over there. Really nice people. Yep. I mean, very professional. So you don't have to trust me. You shouldn't. Yeah, you definitely shouldn't. Doubt everything I say. And basically the format of the conference is people the interview. I was sandwiched between Bob Pardo and Bob Carver, and my middle name being Robert as well. So it was the Bob Cube conference. Amazing, don't you think? And so the idea there is they reprogrammed the idea, this risk appetite indicator, into MT4. So if you want to have the source code, please contact me or contact TradeView, saying that you come from Andrew. Please contact them, and you'll have the code for that. I mean, you have the indicator. I don't think you'll have the source code, but I think you'll have the indicator. So the whole idea is we tried the same thing on, I forgot which one it was. Is it EUR GBP? I can't really see. But anyhow, we tried without the risk appetite indicator. So this is what the equity curve of the strategy that I did worked over there, and the strategy that program. This is how it worked. I mean, it's not a bad strategy, obviously. It's a single security in this case, but this is what it looks like without the money management. It's like the fixed risk that we saw before. It was the light slate gray. Otherwise, the gray line that we saw before. Fixed risk, equity times risk, fixed risk. That's it. The no transmission gear, the fixed risk. Now, next one is with the money management. So prior it was 17%, and this one is 98%. Mild improvement, I would say. And as you can see, like the arrows is when it doesn't work, the strategy takes as little risk as possible. But when it works, it just goes for the jugular. Just load up the track. And this is really how you should be working. So this is with the courtesy again of TradeView. Great guys. Check out the conference. There'll be a link, I guess, in the show notes. So the whole idea is this was done by a third party. This is really what I wanted to say. Like, you don't have to trust me. This is also a test that has been done by a third party to see how it works. So here we go.
Yep. So then, how do people implement this? I mean, you've explained to us how it works, but if someone wanted to implement this, what do you think what would be the best step for them to at least try this out on some of their strategies and prove that it works well?
So hold on. Let me go to my Python source code, and I mean, it's been so long. Sorry, I speak Japanese now. Sorry, I speak in Japanese. I live in Japan. Sorry about that. No. So the variables that we need here, here we go. The variables that we need here are the equity curve. From the equity curve, you always calculate the watermark. So that's the variable. The tolerance is how much drawdown that you're willing to tolerate. It could be like 5%, 10%, 20%. It really depends on what you do, and it really depends on the number of securities that you have. Then you need to have a lower bound. What is my minimum risk that I can have, or what is my upper bound? What is the maximum risk that I can tolerate? And then out of that, you can take a span. So I use a moving average. In my case, this is my real ETF equity curve. So I use 5 days to smooth out the signal because it tends to be noisy. And then it's the shape, whether you want to be concave or convex. So concave again is let me see. I have the memory of a goldfish on Alzheimer.
Here we go, concave. I've got the concave on the screen there.
So concave, okay. Concave is minimum risk divided by maximum risk. So in my case, it would be 25 basis points divided by 1, so 25 basis points. And convex would be max divided by min. That's it. That gives you the shape. Okay. Or you don't even have to bother with that. You don't even have. You can have the straight sample oscillator. Let's say, for instance, you want to raise from 25 to 50 basis points. Just a simple oscillator will do. But as soon as you start moving into like multiple times, the ratio of min to max is multiple times. In my case, it's 4 times. So I need a bit of acceleration to help me through. Make sense?
Yeah. So then what do you recommend for someone who maybe doesn't have a good understanding of their tolerance to drawdown? Because, that can change when you're in the middle of a drawdown with human emotions and expectations not meeting reality. What should a trader do when they're in that kind of situation?
34.
34?
It's not the meaning of life. The meaning of life, as we all know, is 42.
Yeah.
But 34. A Man for All Markets, written by Ed Thorpe. Ed Thorpe, for people who don't know, is the guy who changed blackjack. It was like the beat the dealer, and then the industry changed around it. And then he's also the guy who schools Nobel Prizes. He schooled Eugene Fama. Eugene Fama didn't talk back. Then he schooled the Black-Scholes guys. They definitely didn't talk back. Oops, sorry about that. So that's that kind of individual. And he's also a fantastic ballroom dancer. That's very important, that too.
That's important.
And he said that, it's very important. And he said that actually the number, because I had the same question, and it's a nagging question. And the answer to that question is, let's say, for instance, your investors will tell you, oh, don't worry, at 20%. I mean, you ask them, how much? When will you pull out? Oh, at 20%. So guess what?
Mm.
At 10%, you're going to be in a Bob Marley market. Redemption song, that's all I ever heard. So people are going to start redeeming your ass from 10% onward.
Yeah.
The problem is when you're going to be into a losing streak, you're going to enter the losing streak, then there's going to be the middle game, and then it's going to be the end game of the losing streak. And by the end game of the losing streak, if you anchor to 20%, you'll have nobody. It'll be like rest in peace, Melvin Capital kind of thing. I mean, no disrespect for the person. I mean, but you'll be in a very bad spot. Whereas if you take half of it, you'll be in a better spot because then you can navigate the middle game. But statistically, Ed Thorpe answered the question. I thought it was a very interesting couple of paragraphs in his book. He said you should be at hovering between 1/3 and below 40%, so that actually as you enter the drawdown, you can navigate and your emotions won't kick in. Statistically, you'll be better off. So again, it ties into the shape of the indicator. Does it make sense?
Yeah, absolutely. So I'm just looking in the chat here to see what kind of comments and questions we've got here. Got a couple of more hellos. Hey, Alex. Question here from Ola. This was posted quite a bit earlier in our discussion, but let me put it up on the screen and get your input, sir. So, g'day, Ola. Thanks for the question. Ola's always joining us with great questions. To judge a trading system in terms of the probability of you being able to follow it, what measures would you suggest? Pulsar index?
That's an excellent question. So, in my never-ending book story.
I love that movie as a kid. It's one of my favorite movies.
Awesome, isn't it? I mean, my kids talk about it all day long. So, with Kajagugu. The whole idea there is Pulsar index, exactly. I would use on the numerator performance. So it's the sum of the daily log returns. It's the exponential of the sum of the daily log returns, which makes it very easy to calculate. I mean, basically, let's say you take it 100 days or 200 days or whatever that is, whatever duration you want to take. And then this is the return. So I clock 10% or whatnot, or 20% or 30%. We could actually show my real equity curve on the ETF part of what I do.
Is that in the slides?
I think it's the last one.
Let me have a look. What have we got here?
Something with again super pastel color.
This guy?
Oh, that's the one. Yeah. All right. So this is just truly. This is a truncated version of it. I don't want to show the January to late March, I think, because then it gives I'm a short seller. Remember? So when the market tanked, I'm like, yeah, baby, don't worry about the rent this year. And next either. We're set. So I always truncate that because otherwise it gives a false impression. But to answer the what was the question again?
Let me put it on the screen. Also index, I think, wasn't it? Judging a trading system.
Okay, so this is a very good illustration. So this is the portion that I do on the ETF. So this is my real equity curve, a truncate portion of it, just a slice of it. And the whole idea there is last year my return were north of 40%. Anyhow, the idea is, okay, you clock this much, but how do you get there? So on the numerator is, okay, this is the journey. I clock 10%, I clock -1%, I clock 5%, I clock about 400. Other people said 2%, 200 or whatever that is, it doesn't matter. But then the question is the journey that you did. So it's the grid index. So it's the performance divided by the Pulsar index. So how did you get there? Did you get there volatile? This one was relatively volatile. I really took it on the chin in May, actually, because in May I really went to town on risk. I thought, okay, this is it. They blew their low. That's it, and the market's going to go down. So I took a little more risk. I mean, they were low at that time. There were a flurry of short signals. So I took them, and then I just like got wiped out, and then I rebounded back from there. And as you can see, it's a fairly like neat, and this leads us to the same question that was asked before, and I think it's a lingering question, and it leads us to is how do you stomach all these? And the best line that I've ever heard was in the TV series Billions. I think her name is Wendy, I forgot, the psychologist. He says, when good traders make a good trade, they feel good about themselves. When great traders make a trade, they feel nothing. And literally last week, I had back to back my best day ever, and a couple of days on the road are my worst day ever. I told the amounts to my wife, and like, oh shit, don't worry, I'll clean the mess. But she's like, I never knew that, and I told her exactly this. I had the best and the worst back to back, and I felt nothing. And if you can reach that point, and it's the whole game, and that is something you can only feel two reasons for this. Three things. You need to trust your system. If you don't trust your system, there's no way you will ever get there. Obviously. The second thing, and it's very important, position sizing and risk management is the articulation between the emotional and the financial capital. So what is the financial capital? The financial capital is the returns that you're going to clock. It's how much money you make, how much money you lose. It's very simple. It's very binary. The emotional capital is how you feel about it, how you bring your emotions to it. And if you deplete the financial capital, you can make it back. You will make it back if you work hard enough. And if the market works in your favor, you can make it back. It's not going to be easy, but nothing ever worthwhile is ever easy. Saying that for the married man over there. And but on the other hand, if you deplete your emotional capital, it's game over. You're not coming back.
Yeah.
You're not coming back. So the position sizing and the risk management is really the articulation between this one and the other. So if you risk too little, you don't have a business. If you risk a coffee, you don't have a business. If you bet the house, you won't have a business for long. So the whole idea is, okay, maybe I should be risking lunch money. And that only you can find it. And if it's too high, and this actually, you need to find it in yourself. And using, again, the same indicator, you also need to check with your investors. If you take too much risk, always err on the cautious side with investors. Because one thing that you're going to learn the hard way is that they can stomach mediocre positive return, but they don't expect them to stick with you when you have negative returns.
Yep.
So that's really the big lesson.
Yep.
I hope I answered his question.
Okay, yeah, sure. A couple more questions here and then we'll wrap it up. John was saying he's looking forward to seeing the MT4 indicator. G'day, John. Sorry, you're going to say?
Contact TradeView. Contact Andrew, myself, or TradeView. The conference link is in the show notes.
Yeah, we'll put it in the show notes. Yeah. Okay, good question here from Alex. Actually, he's got two good questions here. Let me put the first one on the screen. There he is. So to clarify, you use a measurement on your equity curve to scale up and down your bet size in some... Oh, there's a comma there. In some cases, don't you want to bet more if you have a losing streak that is abnormally long?
I agree with you. I'll bet more on a different fund manager. Next question.
That's serious, eh?
Yeah. I mean, if you want to bet more on an abnormally long, this is basically what you're doing is Martingale. And I know it's funny because I used to work at Fidelity, and they had a very pernicious way of thinking about this. Like the people in management, when you do your quarterly, I mean, fortunately, they fired those guys. But people in management, they are usually people who fail at being fund managers. People who like what's that? Like the The fund review people are usually failed fund managers, and they always ask the same question. Well, but if the stock tanked, it's something it's a common fallacy in fundamental people. But if the stock tanked, it's cheaper, therefore I should buy some more. Yeah, maybe not. And the problem is that if you double down all the time, it might work. Actually, these days, with a very accommodating monetary cavalry that we have, it might work. But the problem is that when it doesn't, you're out of a job. So prudence would command that actually you risk less as it goes down. Again, Martingale, which is like putting more risk as things don't work. In real life, we don't do that. Like, for instance, let's say you want to, the best analogy is dating. I mean, this gentleman looked really handsome and really, really classy. So let's look the analogy of dating. All right. So let's say you go out and date a lady, or you want to date a lady, and she's like, nah. Okay, take her for coffee. Nah, I'm not interested. Okay, take her for dinner. Nah, still not. Okay. Take her for a bigger dinner. Nah, no. Okay, buy a bunch of diamonds. Nah, no. Then you take her on a holiday trip somewhere. Like, yeah, let's just be friends. Are you really going to invest more? On the other hand, you go for a coffee with a chick. Hey, that is good. She laughs at you. Wow. Then you go for dinner. Wow. She even has conversation with your goldfish. She likes broccoli. All the stuff that matters in life, right? And then you're going to invest more into that relationship. So that's it. So if it works, invest more. If it doesn't, think of pulling out.
Yeah, so an additional comment here from Alex. So as your win streak is high, you bet more.
Oh man, this guy must be a dating robot.
No comment.
Yeah, no. So yeah, sure, of course, Alex, of course. A handsome man like you.
All right. He does have another question, but we'll let some other people have a turn, and we'll come back to that one in a sec. So, actually, John made a good comment here. The market can stay, here we go, irrational longer than.
Your investors can stay with you.
Yeah, exactly. Okay, so here's a question from Andres. It's actually over 2 comments. So what I'll do is I'll read the first part, and then I'll display the second part. So in mean reversion strategies, you have high percentages of profitable trades. This will give you winning streaks of profits. Your formula will increase risk, and then a big loss arises. Would your system work in a better way with trend following strategies versus mean reversion? What are your thoughts?
Right. Okay, let's put out the first slide, where there are all the distributions, and then let's this question. But remember,
yes.
like in the slide.
Yeah, I remember. Let me see if I can. This one here.
That one.
Good question, Andres. Is this a planted question? It's like the perfect question to lead to this slide. Okay.
Can you see the question? Can you show the question again?
Oh,
Sorry,
yeah, let me put it
goldfish on Alzheimer.
Would your system work better with trend following versus mean reversion strategies?
I mean, I'm gonna. Okay, you know what? Tastes like chicken. That's the answer. Now, are we gonna get there? As I trade scale out. Okay, that is a fascinating question. That actually, I answer to the question. I highly recommend people go to the TradeView seminar, and they have a strategy that works. So much so that actually, I commit to trading my children's money education fund using the strategy that we program with TradeView. I commit to that. That's how serious I am. So it's not a joke. But I'm going to answer this from a mathematical perspective. Oh man, I need to drink some stuff. Just give me 1 second.
Okay, sure.
Here we go. I watered the plant with this one, but I guess if that fuels this, it can fuel that. So
I might have a drink myself. Everyone have a drink.
Yeah, let's take a break on this one. So the idea there. Can we see the question?
Yeah,
on the
put the slide back up. Here we go.
This is a fascinating question. Thank you very much, by the way. Merci. All right. So the idea there is, how do we define trend following versus mean reversion? And people usually tend to define themselves by the asset class they're trading as opposed to by the style they're trading. Example, people who write calls in option world, they're short gamma. So this is essentially mean reversion. And as people who were shorting GME quickly got to understand, they're clipping coupon, they're picking pennies in front of a steamroller, a big one called Reddit. So that's, but at the same time, the people who were on the other side of the trade, who were buying out of the money call options, were trend following because the distribution is structured differently. So what makes the difference between trend following and mean reversion? And most people, but let's look at Warren Buffett is the ultimate mean reversion guy. No, Warren Buffett buys value, but Warren Buffett is the ultimate trend follower. I mean, this guy, like all his stocks are like Patek Philippe watches. He buys them and holds it and hands it to the next generation. Mm. He just carries them to the next generation. So it's the ultimate trend follower. It's called a value momentum trend. So he buys businesses that he bequeaths to his grandchildren, if they ever talk to him ever again. But it's a different story. So now the problem with trend followers is they kiss a lot of frogs. Mean reversion guys, on the other hand, they like to be right. And unfortunately, with mean reversion, every now and then you get to be wrong. And when you're wrong, it's catastrophic. Like the captain of the Titanic was the ultimate mean reversion guy. He had a 99% win rate. Well, he didn't show up to explain his loss thereafter, but that's a different story. So does this indicator work better with mean reversion or trend following? That's actually a very good question. Now, how do you switch from one to next? It's by the exit. It's the exit policy. Mean reversion guys, they come in early and they eject prematurely.
You've always got away with words, don't you?
I had to make enemies, and I had to influence people and win friends. I had to win friends and influence like Dale Carnegie. Yeah, I need to read that. Right? So the idea with mean reversion guys is the value guys or whatever they do, like startups or whatever, is they cut short their profit potential. On the other hand, and then they pass the button off to the trend followers who then ride their profits into the sunset. But the problem with the trend followers is they kiss a lot of frogs. Not everything tends to be Amazon or whatever. This is the 2020 hindsight. So how can you switch from the trend following mean reversion into something that combines the attributes of both? The idea there would be to truncate the mean reversion part. You see, in this case, and this is probably the topic for a different podcast altogether, but mathematically, what you should be, what the optimal mathematical distribution is to have to bet a lot on a very high probability, which is what the mean reversion guys do, and then elongate the right tail using a trend following. So consider two trades and scale out instead of scaling in. The people who do systematically trend following, they have by definition, a low win rate strategy, which is by definition a negative gain expectancy. So for them, managing losses is very important. So for them, we're talking about now the concept that we are alluding to is correlation. When we have a bull market, everything tends to fly off the shelf. When we have a bear market, the only thing that goes up in bear markets is correlation. Everything tanks, right? So the idea there, in this case, they have to scale in because the few and far in between wins, they need to scale in on those babies. But on the other hand, they need to cut losses very briefly. Conversely, the mean reversion guys, they do very, very well until there's a big shift in market regime. In which case, they do very well in stable markets. Like, all right, we have a bull. All right, we have a bear. All right, we have a sideways. That's even better. Sideways markets, the graveyards of trend followers, but it's like the paradise of mean reversion. So how do you incorporate both together? Is by actually scaling up. Consider it two different trades. One part where, okay, as soon as you get off the starting block, thank you very much. And then the other one, see you in the sunset, baby. And no, the Titanic kind of thing. that didn't make sense. Did I answer the question?
I think so. And actually, Alex has asked a similar kind of question to what you were just talking about here about pyramiding into positions. Let me put it up here. Do you have do you have systems that pyramid into positions like add to losers, but in a controlled way?
All right. Okay, that's an interesting question. All right, Casanova. I'm sorry because we just remembering the dating analogy from before, and I had some gentlemen like this. So the idea there, pyramiding. Actually, the problem with pyramiding is trends mature, like everything else.
Mm.
And when they mature, it means that basically the more you stack them up, the closer you are to the end. So the idea of pyramiding is actually how you should amortize risk over time. And this is in scaling strategies. And this is something that I've studied at until I was blue in the face. And the conclusion that I came is actually I had it all backwards. So if you want to pyramid, you should always amortize. And the formula for this is super extraordinarily simple. So it's 1 divided by 1 plus by 1 plus n, the square root of 1 plus n. So for instance, on the first one, you should have the entire risk. Let's say you risk 50 basis points, 1%. Then on the second one, it's 1 divided by square root of 2. So 1 divided by 1,414, so somewhere like 70%. Then the third one would be 1 divided by square root of 3, 1 divided by 1732, and so on and so forth. So you amortize risk over time. And so that actually, when the trend matures and when it reverts, you have Ed Seykota said it brilliantly. It's all on the dollar sign. It's a pyramid all the way up to the top, and then at the very end, there's a triangle with an eye. So stack up risk and keep your eyes open at the top.
Okay. We've got a couple more questions here, so we'll zoom through these and then we'll wrap it up because we've gone over time. Here's one from Joey. I haven't seen Joey's name on here before, so welcome, Joey, if you're new. Thank you for your question. This sounds like reinvesting your profits into your bankroll and thus increasing your bet size during upswings.
I concur.
Okay. Okay, we're getting loose now, aren't we? We should wrap this up soon. Thank you, Joey. One more from Alex, and I think this will probably be the last one for the day. Let me put this one up. New firms are combining high-risk strategies with tail risk hedges. So when they win, they pay a rake percentage with lotto ticket puts, and when they lose, they win big on the hedges. What are your thoughts on this?
Hold on. Combining high-risk strategies with tail hedges. Okay, so there's a lot to unpack here. Hold on. I think,
maybe we should leave this one for another time.
But I can do a 1 minute version of it. Okay. So trend following basically is a lottery ticket. Again, it goes back to the TradeView conference. Trend following is a lottery ticket. When you get into it, it's a lottery ticket. It might not work. Most of the time, it's wrong, and sometimes it works well, sometimes it works sometimes it works a lot. Tail hedges is like, correct me if I'm wrong, but I'm not entirely sure I understand because it's just a two-liner. Tail hedges, would it be, what's his name? I met him actually. I met him. God, he was an arrogant. He was an arrogant kind of. Oh, Nassim Taleb. Damn. I mean, he speaks French. So it's fantastic. He's a brilliant gentleman, but it's not an easy person to. It's not exactly approachable. Brilliant mind. So the tail hedges is probably, if you refer to that, actually very few people put it in place, because how to put like tail hedges is basically out of the money near months options. That's the way I would do it. Any other way is tail hedges. I don't really understand how to do it. The high risk bet. One thing to explain here, liquidity is the currency of bear markets. I'm a short seller. I know that. So when liquidity evaporates, you don't own anything. You don't own the security. The security owns you. It's the Tony Soprano. I own you. Oh, you know what I mean? God, this is a stand-up comedy that you just had for 1 hour, right?
This is the loosest interview I've ever done, but it's been great. So don't be upset. You definitely win the title for that one, Laurent.
Time
I
to
think
put sex back into quants.
I think we might start wrapping up there because we're way over our time now. As much fun as we're having, we should probably get going because my tummy's rumbling. You can probably hear it on the microphone. So it's time to go and grab some lunch. But all right, so Laurent, I mean, you've shared a lot of great stuff with us today. We're getting some thank yous in the chat. Where can people learn more from you or get in touch with you? Where can they go?
So I'm quite active on Quora. Quora is like the Yahoo answer. So you can find me on Quora if they have questions. I answer them for free. You can message me via Quora, LinkedIn. That's pretty much it, really.
Okay.
I mean, whenever people have questions, or like I also wrote oh yeah, I did that. I wrote. I mean, that was a funny story again. I love funny stories. Quantin Steel, like, which is they have a training for quants. One day they contacted me. I said, no, sorry, I don't want to teach anything. Like, no, we want you to enroll and learn. Ah, okay. So teach what? I said, well, I do short selling. And then I wrote a course about quantitative short selling and how to do that, like algorithmic short selling using Python. And then I went online and I saw the people giving courses, and like I was, God. But I did this one out of integrity. So if people want to reach me, they can reach me through the Quantinity platform. They can reach me through Quora. They can reach me via LinkedIn or anywhere. Even no Facebook, please.
No.
I mean, no.
Okay. And did you want to mention quickly this Trader Logics thing? Because I think this is quite a new venture. Yeah, quickly.
Yes.
So, want to mention that?
So yeah, I mean, Trader Logics is something done by Rana Russi, and the difficulty, and I should have put this in. I mean, when you want to do algorithmic trading, the difficulty is not about trying. I mean, you need to be a systems engineer, then you need to be a development engineer, then you need to worry about socket, then you need to worry about this and that and the other, and then finally you can think about the markets. So, I mean, literally, this is a journey that I had to do. So, programming all this, the socket, the backtesting, the environment. You don't want to do that. Like, if you want to drive a Ferrari, if you want to drive a Formula One, you don't want to have all the parts of your Formula One delivered in your backyards for you to mount them yourself. You have $1 billion idea. You want to start driving it right away, and this is what Trader Logic does. So it takes care of all the connectivity, it takes care of because the programming, and I know that very firsthand in my first venture. Like I had a programmer, and when I fired his ass, I told him I'd rather get cancer than ever work with you again. Because this guy was like, oh yeah, there's a bug, but wait, okay, how long will it take? No, but this is not what I want. No, but this is what you told me. No, this is not what I want. No, this is what you told me. And then, okay, how long will it take? Almost there. It lasted for years and years and years. Whereas you don't want to be a systems engineer, you don't want to be a development engineer, you don't want to take care of all that. What you want is you want to play video game. You don't want to build the Apple One. And this is what Trader Logic does. So it takes care of all the back side of it. And also I'm an investor here with Trader Logics and also contribute, like I'm building a portfolio management system. So a word on portfolio management system, this is what I've done for a lot of hedge funds. And I do professional grade, hedge fund grade stuff. Like I build Iron Man suits. You see, people ever wonder why people why Iron Man doesn't have a low-tech auto radio. I mean, he could listen to CNBC and, wow, what's the share price of Stark Industries? And, oh, while I'm at it, I could even listen to Dolly Parton. He doesn't need that shit. Because he's getting his ass kicked by aliens. So you don't want a portfolio management system that tells you about your Sharpe ratio and what's the analyst saying and what's the rating and blah, blah. You don't need that shit. You're not there because you're getting your ass kicked. There needs to be a very precise transmission. It's a front desk tool for front desk people. It's a trading tool. You need to make trading decisions out of it. So I'm helping on that side. And I'm very excited because when I saw Ran Arusi is also the person who developed like open source, the Yahoo Finance download on Python. And
all right.
Logic combines all kinds of languages together. So it's really exciting. It's really going to bring a lot of retail people who do not have a coding background into the algorithmic trading, I believe.
Okay.
I hope.
All right. So I'll put a link for that in the show notes so people can find it. I assume it's tradologics.com or something like that. Yeah.
Yes.
Okay.
You were very excited about that the other day when we had a New Year chat.
Yeah, I didn't know it existed, so it's always exciting to see new things coming out. So, yeah.
Yeah, we were talking. You were like, yeah, keep talking. Wow, this is cool. This is definitely not what I'm saying. You were excited.
All right, well, let's wrap this bad boy up, and so we can get on with our evenings or afternoon. So, just looking in the chat, we've got quite a few thanks. Let me just post a few up to finish on a positive note. This one's from Ston. Thank you, guys. Very informative. We'll have to go over this again. Absolutely. The recording will be available on bettersystemtrader.com and also on the YouTube channel. We got a thanks from Alex, the dating guy, as you said, Laurent. John, looking forward to seeing what I missed at the beginning. Definitely need to catch the beginning, John. It's great. Here we go. We've got some Japanese and French from Andres. Merci, Laurent. Domo arigato, which I assume sounds like Japanese. Go on.
Hey, I have a question for you.
Oh, uh-oh.
I mean, yeah, first I want to honor you. I mean, you're providing immense value. No, seriously. No, I'm very. Hold on. Let me put my serious face. Doesn't come naturally.
No, it doesn't suit you.
No, okay, forget about the face. But I want to honor you. I mean, you provide immense value. I listen to your podcast while programming. Like, wow, this is interesting, and you provide immense value. And may I ask you, why do you do it?
Why do I do it?
Yeah.
No one's ever asked me that. I think a couple of reasons. I guess that, there's a lot of shitty trading stuff out on the internet. And, when I started out, I didn't know who to believe. And, well, this was actually probably before the internet. But, I got scammed and didn't know who to believe. And I think that's definitely a big problem out there. So hopefully, my contribution with all the amazing guests can put some good quality work out there and help people along the way. And, I like talking to traders. And I have to admit, I get a lot of benefit out of it as well, which as, I apply some of these techniques to my own trading. So, yeah, I think it's a benefit for everyone who listens and all the guests that come on and share. I mean, there's some amazing traders out there that, have some really interesting ideas. And actually, this year I'm going to try and do more interviews with kind of undiscovered people. There's amazing websites out there that people don't know about and some good concepts. I've got some undiscovered people coming up in the next few months. Actually, I've already booked some. So I think everybody enjoys it. And it helps to kind of cut through some of that crap, hopefully, that's out there on the internet. So thanks for asking, Lauren. I appreciate that you care enough to ask that. So absolutely.
Thank you. Thank you.
Thank
in
you.
the name of all the traders. I mean, for all the people who all listen to all the silent majority, thank you.
No problem. All right. Well, I think we'll finish up on that note. Thank you very much. I'm getting a lot of good thanks in the chat as well. So let's have a look at a few more. Let's finish on a high. Thank you, one of the solid, reliable, passionate voices over the years in the trading space. Thank you, John. Really appreciate that. And he's got another good comment here about the guests. So many great thinkers and doers in the field you have shared with us. So that puts you as well, Laurent, into that space. Always enjoy chatting to you, and it gets a bit crazy at times, but we appreciate you sharing all your knowledge. And we'll have to do it again sometime. I know you've got more stuff hidden away in that brain of yours, so maybe we can do it again another day. I'm not even sure what you're doing there, but let's wrap up now. So thanks again. And and thank you very much for everyone for attending today, and I hope you got some great stuff out of it. And please share it with your friends, your trading friends, because we've got a lot of great content on the YouTube channel and on the bettersystemtrader.com website. So please share the word and get all this quality information out there, and enjoy your week next week. Thanks, Laurent. We'll be in touch.
Thank you.
Take care. Cheers.